Welcome to Stocks Review. Click the subscribe button for more up-to-date stocks and portfolio review. Today we are going to take a look at Tattooed Chef. Stock ticker symbol TTCF. It is headquartered in the USA and service regions majorly in the United States now. You may ask why we should care about where the company is headquartered? This is because companies in developed countries tend to be better regulated, whereas companies in developing countries tend to have higher growth, but also more risk. Companies that are headquartered in authoritarian states also have higher political and regulation risk. The service region may give us a clue of the company's overall stability and long-term growth potential. It has a market cap of $750 million and is considered a small cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the consumer staples sector and packaged foods industry. Tattooed Chef is a plant-based food company, produces, and sells a portfolio of frozen foods. It supplies plant-based products to retailers in the United States. The company offers ready-to-cook bowls, zucchini spirals, riced cauliflower, acai and smoothie bowls, cauliflower crust pizza, and plant-based burgers. Its products are available in private label and Tattooed Chef brand names in the frozen food section of retail food stores. As of December 31, 2021, it operated approximately 14,000 retail outlets. In short, it is a plant-based food company majorly sells frozen foods. Its price has been quite stagnant recently. It has a 4-year price return of -10% and significantly lags the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. The revenue growth is consistent and the revenue trend looks very strong. The revenue trend is important as growing companies often have sales go up first followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. It is not profitable now. The net income trend looks very bad. The profit is going deep down in the negative. This is not a good sign. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been issuing more shares in the recent years, probably for funding its growth. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It does not pay a dividend yet. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of Tattooed Chef is very bad and significantly lags the performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly with a slight decline in growth as time goes by. Tattooed Chef has a 4-year total return of -10% with a 4-year compound annual growth rate of -2.5%. If you had $1,000 invested 4 years ago, you would have $900 now. Currently, the price is at around 9 with a 52-week high at 25 and 52-week low at 9. It is near the lower end of its 52-week range. It has a PE ratio of -8.6 and forward PE ratio of -16.7. It has a cash position of $92 million and long-term liabilities of around $8 million. The ratio of cash, debt, and market cap may help us evaluate the default or bankruptcy risk and what % of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. Tattooed Chef is considered a no-moat company according to Morningstar's rating. Now, about the future projection. Currently the margin is minus 41% and future margin after 5 years is expected to be 12%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. It has a 5-year forecast revenue compound annual growth rate of 13.1% and 5-year forecast EPS compound annual growth rate of 8.6%. The near-term growth is expected to be good. It has missed all of Analyst consensus EPS estimates in the last 4 quarters. That's a disappointing performance. The overall Analyst recommendation rating is a buy with trend shifting towards buy recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 3 analyst 1-year price targets, the range is 13 to 18 with an average price of 15.6, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 2 kinds of discounted free cash flow model results for a more comprehensive review. If we run the TTCF perpetuity growth model, the fair price is 9.9 with an upside of 10%. If we run the TTCF terminal revenue model, the fair price is 12.5 with an upside of 26.4%. Now we compare Tattooed Chef with U.S. Treasuries and SPY. It cannot be emphasized more that the U.S. 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 2.9%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY is at around 10%. The SPY has an average forward PE around 18.8 now. Tattooed Chef has a dividend plus 10-year growth forecast plus shares buyback yield at minus 4.4% and a forward PE around minus 16.7. We have to be cautious that this is just a rough prediction of Tattooed Chef's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like Tattooed Chef is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all the information above to give us an overall impression of Tattooed Chef. In summary, Tattooed Chef is a small cap and profitable company with good growth and no moat, and probably overvalued now. If Tattooed Chef can deliver more growth than estimated and turn to profit faster, it may be a stock to consider. Now that's a review for Tattooed Chef stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.